Welcome to the first in our series of 4 short CPD sessions based around the mortgage market review. This CPD session will last approximately 20 minutes, and as a professional mortgage advisor, you can log this time as mortgage-related CPD. For other membership categories, this can be logged as My CPD. The first session will be based around responsible lending. We will first look at the background for the mortgage market review, and then the rules that affect the lenders, and then some frequently asked questions affecting lenders. So let's first have a look at the background to the mortgage market review. Why did it come about? What was the regulator hoping to achieve? And what were the main outcomes? The global financial crisis of 2007-2008 resulted in the threat of total collapse of large financial institutions, the bailout of banks by national governments, and downturns in stock markets around the world. In many areas, the housing market also suffered, resulting in mortgage arrears, evictions, and prolonged unemployment. The crisis played a significant role in the failure of key businesses, declines in consumer wealth, and a downturn in economic activity, leading to the recent global recession. The country witnessed enormous disruption in the UK mortgage market as a result. Because of this, the regulator has sought to protect consumers not only by ensuring that financial systems are prudentially sound, but also by ensuring that firms conduct their business fairly. Both have been clear objectives of the review of the mortgage market: to ensure that the UK has a mortgage market that works better for consumers and a market that is sustainable for all participants. The regulator recognised that the market has worked well for many consumers. The vast majority of mortgage borrowers will come through this recession meeting their mortgage payments and keeping their homes. But it has been a cause of major economic distress for others. The existing regulatory framework has proved to be ineffective in constraining particularly risky lending and unaffordable borrowing, and clearly there has been a need to address this. So the FSA, as it was at the time, proposed a fundamental change in their approach to the mortgage market. This change reflected the FSA's changed approach overall to supervision and risk assessment. The FSA also recognised that consumers are not always able to protect their own interests, and therefore proposed to rely less on disclosure and to intervene where necessary to curb sales of high-risk products and sales to particularly vulnerable borrowers. This means targeted product regulation where appropriate, and a clear responsibility on lenders to assess affordability. The FSA at the time had 2 main aims for the mortgage market review, and these are still shared by the Financial Conduct Authority. The first aim is to have a mortgage market that is sustainable for all participants. This means lenders have sustainable business models which are adequately capitalised, while at the same time remain competitive, innovative, and competent at what they do. A regulatory regime that's predictable, clear and transparent, where regulation is not a source of volatility, and minimises the pro-cyclical impacts on house prices, while helping to minimise mortgage fraud and other forms of financial crime. And also where the costs and risks of lending and borrowing are kept within the market and are not borne by wider society. The second aim is to have a flexible market that works better for consumers. This means that it offers a range of products that meet the needs of different consumer types to allow individuals who can afford it the opportunity to buy their own home. It is one where consumers clearly understand the costs and risks of mortgage borrowing, and consumers understand the implications and risks of considering property as an investment option rather than primarily as a home. And finally, Distribution helps to achieve good outcomes for consumers and provides a professional service with the numbers and complexity of products reflecting the needs of consumers rather than the firms, and where incentives in the distribution chain work for the consumer. The majority of the Mortgage Market Review changes came into effect on the 26th of April 2014. There are 4 main areas that it covers. The first outcome is responsible lending. Lenders are fully responsible for assessing whether the customer can afford the loan, and they have to verify the customer's income. They can choose intermediaries to do this process, but the lenders are responsible. They're also still allowed to grant interest-only loans, but only where there's a credible strategy for repaying the capital. We'll look at the responsible lending outcomes in more detail in a moment. The second outcome is the disclosure process. This covers the initial disclosure document and the key facts illustrations and the requirements where and when to use these. We'll look at that in a separate session. The third outcome covers the advice process. The non-advised sales process has been removed, and we are now only looking at either a fully face-to-face or telephone advised process or an execution-only sales process. Again, we'll look at this in a further session. And the final outcome is systems and controls. This covers such things as staff qualifications, ongoing assessment of competence, spans of control, documented processes ensuring they are fit for purpose, monitoring of the advice and the processes, appropriate MI, fraud controls, and record keeping. Again, we will look at this in a separate session. So that covers the background to the Mortgage Market Review, and next we will move on to the first of the outcomes, responsible lending. Responsible lending is, as the name suggests, the responsibility of the lender. There are 3 key elements to responsible lending: the affordability assessment, the interest rate stress test, and the interest-only rules. We will look at the 3 of these key elements in turn, and also look at transitional arrangements. So let's move first of all on to affordability. The FCA's rules for affordability assessment mean that the lender must assess whether the customer or the guarantor will be able to pay the sums due, and they must demonstrate that the mortgage is affordable. In order to demonstrate the affordability, the lender must take full account of the customer or guarantor's income. This needs to be net of income tax and national insurance. It must be evidenced independently of the customer, which means self-assessment is no longer allowed. It can be employed income, self-employed, pension income, investment income, as long as there is evidence of how much and how long this income will last for. Each lender will have its own rules about what is acceptable, and these should always be taken into account. As well as income, the affordability assessment must also take into account expenditure. This falls into 3 areas. First, committed expenditure, which would include loans, credit cards, hire purchase, maintenance, etc. And then essential expenditure, which would look at the customer's household expenditure, such as gas, electricity, heating, council tax, building insurance, etc. And finally, quality of living costs. These would include things such as clothing, household goods, personal goods, travel, non-essential transport, etc. So by analysing the income and expenditure of the customer would give the lender a very clear indication of the affordability of the mortgage. However, this is not required if the new mortgage is replacing an existing mortgage, either with the existing lender or even a new lender. And it can be for a different property, but only if there is no additional borrowing, with the exception of fees, there is no change to the existing term or type of mortgage or the parties involved in the mortgage, and it is not being done to avoid arrears. The next rule for lenders is that they must consider the effect of future interest rate rises, and to do this they need to look forward over the next 5 years, unless of course the mortgage has a fixed rate of 5 years or the term of the mortgage is less than 5 years. And they have to justify affordability over this period with regard to what the market expects interest rate rises to be, and also what the Financial Policy Committee recommendations on appropriate interest rate stress tests are. And one final thing they must take into account is that if there is an indication that interest rates are likely to fall or rise by less than 1%, they must assume that interest rates will rise by a minimum of 1% over the 5 years. The interest-only rules for a lender are fairly straightforward. The lender may only enter into an interest-only mortgage or switch a repayment mortgage to interest-only for all or part of its term if it has evidence that the customer will have in place a clearly understood and credible repayment strategy, and as far as it's reasonably able to assess at that time, the repayment strategy has the potential to repay the capital borrowed and any interest reasonably expected to be accrued under the interest-only mortgage. It's been recognised by the FCA that there will be situations where the responsible lending rules continue to bite for existing borrowers. This would include where there are material changes to affordability, the borrower does not have an acceptable repayment strategy for an interest-only mortgage, or the borrower wishes to move their mortgage to another lender. In such scenarios, while an affordability assessment should apply because there may be a material impact on affordability, there may be some situations where, due to extenuating circumstances, such a change may be in the interests of the borrower and lead to a better outcome than remaining in their current situation. It's not possible to predict every such circumstance in the rules. Therefore, lenders are allowed flexibility to make their own decisions about making exceptions to the affordability and interest-only rules for existing borrowers. Obviously, there need to be some rules around this, so lenders are allowed this flexibility, whether or not it materially affects affordability, as long as there is no increase in the current amount outstanding. They can take into account fees and have these added on to the mortgage, and we can also look at additional funds that are required for essential maintenance or repairs to the building, as long as the value of the property is at risk if the repairs or maintenance work are not carried out, and the additional borrowing is used solely for the repairs and maintenance work. And of course the lender has to have credible evidence for the cost of the repairs or maintenance work. And finally, the flexibility can only come into account as long as the lender has judged that the proposed transaction is in the customer's best interests. So now we have covered the main rules that affect lenders under responsible lending. So that's affordability, the interest rate stress test, and the interest-only rules. And we've also had a look at the transitional rules that apply to existing borrowers. There are other rules that affect lenders. These include changes to income expenditure, debt consolidation rules, rules around business lending, and also high net worth customers. It is worth looking at the individual lenders' rules around all these 4 areas before making any decisions on what the best mortgage would be for your customer. The next few screens show a selection of frequently asked questions concerning Mortgage Market Review responsible lending. Please note that these frequently asked questions have no voiceover accompanying them. If you want to have more information about the MMR, then visit the FCA website. So that concludes our session on the Mortgage Market Review Responsible Lending. Remember to record this against your CPD. The next MMR session will cover the topic of the disclosure process. As a professional mortgage advisor, you can log 20 minutes as mortgage-related CPD. For other membership categories, this can be logged as My CPD.